If you remember in the previous class, we talked about the dual aspect concept, and we said in the accounting we have two aspects. We have assets and we have claims against assets. Assets are what the company owns. Liabilities, what the company owes to other. Owner's equity, what the company owes to the owner. And we said that always this both sides should be equal. So equal, it should be always correct. Always after any transaction, our assets should keep equal to liabilities plus owner's equity. So as we mentioned, as we defined, this is all kind of revision of previous chapter about accounting equation. We said assets are resources that possess future economic benefit. Liabilities are outsiders' claim, creditors' claim on the assets and represent the debts and obligations of the business. Owner's equity is the owner's residual claim on total assets. So those are what the company owns, and here all the claims against the company assets. This equation is building block of statement of financial position, and what we call it the balance sheet. So after any transaction, we should always make sure that the effect of transaction keeping those sides equal, keeping the accounting equation correct. This is what we need to keep in mind. As example, if our liabilities are 4,000, what we owe to others is 4,000. What we owe to the owner is 6,000. So the total is assets is 10,000. Actually, here it's not capital, is owner's equity. Okay, so that's what we need to keep in mind about the accounting equation. If you remember also, we said accounting equation is assets, liabilities, and owner's equity. We have, for assets, we have current and non-current. For liabilities, we have current and non-current. We have four components for the owner's equity, which are capital, drawing, revenue, and expenses. Capital is what the owner puts money in the company. Drawings is what the owner withdraw from the company. We have revenue is the money come to the company. Expenses the company pay, and normally we take the net of it, which is revenue minus the expenses, either profit or loss. That are the components of owner's equity. Assets. What are the assets? Are items of value owned by a business. They are bought and held by the business to help them generate income and make profit. They are the economic resources of a business that are expected to benefit in the future. Which means assets are what the company owns. They're gonna to use it to benefit in the future. Example of assets, we have piece of land, building, furniture, motor vehicle, office equipment, inventories or stock of goods, cash in bank. All of those considered under assets, which is what the company owns and can use it to get benefit in the future. Liabilities. Liabilities, as we mentioned, is what the company owes to others. When we say others, it means anyone exclude the owner. Okay? So are amount owed by a business to external parties. If you notice that it is for external parties. Liabilities are outsider claims, which are economic obligations of a business payable to outsiders. Examples of liabilities, we have creditors. What are creditors? Creditors are people we buy stuff from them. We buy on credit. Let's say I have a factory. I have a factory to fill glue. So I buy the glue from another company. I don't produce the glue. I only fill inside the tube. So the company which I buy the glue from them, I don't pay them on cash. I pay on credit. So those we call them creditors, which are the people we buy from them on a credit. Okay? Or maybe we don't pay the rent directly, we delay sometimes the rent. Also the landlord will be creditor for us. Bank overdraft, if we withdraw money from the bank more than our balance, is bank overdraft. Tax payables and salaries payable, those expenses we should pay at this accounting period, but we didn't pay. So those are expenses, we should pay it in this accounting period, but we didn't pay, so we call it as payable. Owner's equity, as we explained, have 4 components. What are owner's equity? Is the amount of the owner's interest or investment in the business. Owner's equity can be divided into 4 components, which are capital, drawings, revenue, and expenses. Capital, drawings, revenue, and expenses. Those are the 4 components of owner's equity. Capital, as we mentioned, is what the owner put in the business. Drawing, what the owner withdraw from the business. Revenue is the income we receive. Expenses is what we pay. Normally, we take the balance of revenue minus the expenses. So we reach to either profit or loss. If the revenue is more than expenses, is profit. If the revenue less than the expenses, is loss. So those, as we mentioned, are the component of owner's equity. Capital is owner investment, cash or other assets. Drawing is cash or other assets during the accounting period for personal use, is what the owner withdraw. Revenue, gross increase in owner's equity resulting from business activities entered into for purpose of earning income. Expenses, cost of assets consumed for services used in all process of earning revenue. So all those components together, as we mentioned, it means owner's equity. So based that, we can say we have 2 components that are decreasing the owner's equity, 2 components that are increasing the owner's equity. Expenses and drawings, they are decreasing owner's equity, while capital and revenue, they are increasing owner's equity. So based on that, owner's equity is capital plus revenue minus expenses minus drawings. So increasing in capital cause increasing in owner's equity, increasing in revenue cause increasing in owner's equity, but the expenses and drawing, they're gonna to decrease owner's equity. Okay, so for that reason, the owner's equity is equal to capital plus revenue minus expenses minus drawings. So as we mentioned, owner's equity has 4 components, which are drawings, expenses, capital, and revenue. Okay, so owner's equity will increase when we increase capital. When we invest more in the company, our equity, what the company owes us, will increase. When the company generates revenue, at the end, this revenue will be owned to the owner. Okay, so more the company generates revenue, more the owner's equity increase, because this generated revenue, the company should give back to the owner. So is that what the company owes to the owner. Drawing is withdrawal from the owner, from the withdrawing the owner do from the company. So drawing is gonna to decrease the owner's equity, because he is withdrawing from the money. Okay, and expenses same. More we do expenses, less owner's equity we have. So based on that, the owner equity equal to capital plus revenue minus expenses minus drawings. For that reason, we have the plus and the minus. So let's go to what we call it accounting equation. Is again same what we are learning. assets equals to liabilities plus owner's equity. Asset is what the company owns. Liabilities, what we owe to others. Equity, what we owe to the shareholders or owner. Now we come to the analyzing of transaction. This example, we call it analyzing the transaction. Which means if you want to analyze, if any transaction happen, we have to analyze it to be able to record it in the book. If we have any transaction, we have to analyze it to be able to record it in the book. Let's take this example. Cindy Opson invest, this is a name of a person, okay? Invest $10,000 to start the business. Osborne Consulting Inc. This is the name of her company. Sells 10,000 of common stock in exchange for her cash investment. What is the effect of this transaction on the accounting equation? Is the owner invest money in the company? If we want to reflect it in the accounting equation, if you remember our accounting equation, we said assets equal liabilities plus owner's equity. Here, the owner, this is the owner, give money to the company. This is a company. I'm sorry, the building is not nice at all. I'm trying to make it as a building. Oh, okay, doesn't work. So this is the owner giving money to the company as investment to make the company, okay? So he's giving money to the company. So if we want to reflect this one in the accounting equation, when owner give money to the company, it means the owner making capital. So we have increase in equity, owner's equity as capital, common stock, okay? This is one side. As we remember, we get each transaction has dual aspect. So the second side of the transaction, that when the company, what he give to the what the owner give to the company to make what we call it common stock or capital is the cash. So now the company get extra cash. So cash is what? Cash is asset. So we have extra 10,000 in the asset side. You notice we added the amount, similar amount in both sides. So if you remember, we said in accounting equation, after each transaction, both sides should be equal to each other, right? And to make sure that this one happening, let me explain to you here. We have the accounting equation is assets equals to owner's equity plus liabilities. If you want to keep this equation correct, if we add, let's say 10 in the asset, what we should do to keep this correct, this equation correct? Possibilities. What we need to do to keep this equation correct? We have to add 10 in the other side. You mean from here, right? 10. Yes. This is one possibility. What is the another possibility? So now we get transaction adding 10 to assets. What is the possibility to keep this equation correct? And minus from the same side. That's right. So as I'm saying, to keep this equation correct, either we need to add similar amount in both sides, or decrease similar amount in both sides, or increase and decrease similar amount in one side, okay? So like this, our equation will be correct always. So this is the first example. Let's go to the second example. Purchase supplies on credit. Osborne Consulting Inc., this company, purchases office supply on credit. They agree to pay $350 within 30 days. What is the effect of this transaction on the accounting equation? We are buying on a credit, okay? So our creditors, which are liabilities, increased 350. What we bought supplies, and so those supplies are assets, so increased 350. So like this, you will see we have 350 supplies in the asset side. We have 350 and the liability side as accounts payable. Accounts payable, it's the name of the creditors. So either we write creditors, we write accounts payable, or we put name of the company. Let's say like IKEA or whatever name of the company which we bought from it on a credit. Okay. So when you buy on a credit, either you write accounts payable, either you write supplies, or you write, if you are buying from someone on credit, either you write creditors, either you write accounts payable, or you write the name of the company you are buying from it. Okay, so this is how you do the transaction. Purchase equipment for cash. The company, which is Osborne Consulting Inc., purchases equipment. They pay cash of 40,000. In this transaction, we have equipment, we have cash. Equipment is non-current assets and cash is a current asset. So we have increasing in the equipment in the non-current asset, and we have decreasing because we bought equipment. Our equipment increased. We pay by cash, our cash decrease. So like this, we can say that we have minus cash, our cash decrease in minus, where our equipment increase, so our accounting equation keep correct. Another transaction, borrow cash from the bank. This company borrowed 12,000 US dollar cash from the bank and signed 2-year note payable to the bank. What are the two accounts involved? Which one increase, which one decrease? Under assets, we have cash increased 12,000. Under liabilities, we have notes payable increased 12,000. Our accounting equation keep correct. Thank you. Another transaction. Provide services for credit. Osborne Consulting Inc. performs $1,900 or $1,900 of services and in return receives customer promise to pay $1,900 within a month. What is the effect of this transaction on the accounting equation? Plus accounts receivable 1,900. The equity is plus 1,900 as revenue. Another transaction, partial payment of accounts payable. We do partial payment for our accounts payable. Osborne Consulting pays $150 US to the store where it purchased 350 worth of supplies. What is the effect of this transaction on the accounting equation? It's accounts payable decrease amount of 150. So what is the other side of transaction?
Miss, so on the asset side, the cash decreases.
Yes, that's correct.
Minus 150.
Yes, like this, we keep the transaction correct in both sides. Sorry, we keep the both sides of the equation equal to each other. That's correct. Thank you. So are you ready for a challenge? Let's do this one. At the end of first month of operation, Robinson Consulting Inc. has asset total 57,000, stock equity totaling 32,000. What is the amount of this company total liabilities at the end of the month? Yes?
25,000.
25,000. How you calculated?
Yeah, because asset minus with equity.
Yes, it's assets minus owner's equity is 25,000. Thank you. Very good. Very good. Thanks for all of you for participating in the class.